So while this is all going on because there's so much paper, it's affecting the fixes. But it's patently clear to all physical-facing liquidity providers that this paper to physical dislocation is coiling gold and for a really large catch-up rally. However, this coiled spring in silver is far, far tighter. And under this synthetic action, silver is gearing up for a very large upside breakout through what are perceived to be chart-painted resistances, synthetic resistances.
The longer-term technical postures for gold and silver remain significantly bullish. Both markets have seen their near-term chart postures also improve over the past few weeks. This will continue to invite the chart-based speculators to the long side. Veteran commodity trader Andrew Maguire underscores that the current focus on war and geopolitical tensions is distracting investors from the real bullish drivers for gold and silver. He mentions that deeper financial risks, including instability in the private credit sector, fund gating, and hidden defaults, are building beneath the surface. According to him, these pressures combined with rising energy prices could create a stagflationary environment that ultimately supports higher precious metal prices. While many investors are temporarily rushing into the US dollar as a safe haven, this trend could reverse once the broader economic impact becomes clearer. He explains that strong inflows into physical gold and silver are already building quietly and could eventually surprise Western traders who are focused mainly on paper market movements. He also highlights the growing role of the physical market, particularly through the Shanghai Gold Exchange. Furthermore, Maguire believes rising central bank and institutional demand is creating a foundation for the next rally, predicting gold could move toward $6,300, while silver could potentially rise toward $230 as supply shortages tighten. Silver has outpaced gains for gold so far this year and looks to be the hedging asset of choice for investors, with prices set to notch a 10th straight monthly gain, the longest such streak on record. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Andrew Maguire's recent interview.
The war focus is actually hiding the main bullish for gold and silver drivers, which are the private credit implosions, the fund gating, the asset remarking shenanigans that we're going through. I mean, this is really off people's radar. And these things are running headlong into an unfactored, war-induced, stagflationary environment. Clearly, if you're going to get oil up at $100 and it went up to 120 the other day, so it's right now I'm looking at it 99 and change, so really that persists. And we don't talk about stagflation. And as soon as the war fog dollar enthusiasm evaporates, because that's really the main people racing to the dollar, the safe haven dollar, and obviously, but the real safe haven inflows into physical gold and silver will yet emerge. They're there, you just can't see them 100% at this point. And this is going to leave Western traders severely wrong-footed. Now, private credit has no Fed credit safety net, and which is why the sector's rising bankruptcies, shadow defaults, gating of funds, you can't get them out if you're in there. And all of this is once again leaning on the too big to fail bank majors, raising the odds of a 2008 debt spiral. Private credit represents 35% of all total US insurers' investments. So, and if you remember, it was AIG that caused the problem last time. Now, while these cockroaches start to spread from AI to housing, also migrating across the pond to the UK, it's going to be realized that the race to swap debasing dollars for gold and silver has not yet even been ignited. In fact, the speculative crowd element that always chases gold and usually get rinsed, they've just received an underlying support raft. And it's going to be much, much harder to shake them out. And obviously, we're seeing a lot of volatility, and a lot of them are shaken out. But essentially, we'll look at why we're building fresh support levels. Now, with the SGE now controlling global physical market liquidity, the longer this turmoil lasts, the more supportive these aggregating higher physical market price levels become. So because producers, the hedgers, institutional buyers, they're forced to lock in these higher physical market support levels, which in the process is constructing the next central bank and sovereign stair step to rally from. Now, every one of these global drivers are underpinning the next leg of central bank, sovereign, institutional, safe haven gold demand. It is just going on under the covers. All physical facing liquidity providers are now gearing up for plus or minus 6,300. I mean, that's everywhere now. And we're talking about spot gold here. And in silver, given the as yet undelivered, asymmetrically imbalanced naked short, LBMA CME silver warrants are still being stood for delivery into a growing 8-year supply deficit. The lowest target for silver remains around 140, the lowest target, with a rising expectation of $230. It's going to become the next rising stair step to rally from. And we'll look at the charts as to where those breakout points should be. But let's start by looking at the current war-induced footprints, picking up the thread from our end of February market update into the 1st of March action in gold and in silver. And when looked at in comparison to the leveraged, bearishly skewed, undeliverable paper market settlements versus what we're evidencing in the physically backed gold and silver Shanghai settlements, they uncover a race by central banks and sovereigns and institutional actors to convert the stronger dollar and US treasuries into gold and silver. It's an opportunity because gold and silver trade as currency crosses against the dollar. Buying one side of the cross sells the other. So when everyone piles into the dollar under this plain vanilla bearish skew, it creates opportunities to de-dollarize at more favorable rates. That's what we're seeing. And as this conversion, or as it would be actually much more accurate to describe alchemizing paper to physical process, as this rolls out, due to the automated inverse unallocated foreign exchange gold selling against the rising dollar, both of them really are really, we're talking about fiat, essentially fiat gold and fiat the dollar. It provides the synthetically driven downside momentum, which in turn bearishly influences the LBMA gold fixes. So while this is all going on because there's so much paper, it's affecting the fixes. But it's patently clear to all physical-facing liquidity providers that this paper-to-physical dislocation is coiling gold and for a really large catch-up rally. However, this coiled spring in silver is far, far tighter. And under this synthetic action, silver is gearing up for a very large upside breakout through what are perceived to be chart-painted resistances, synthetic resistances, which we will look at shortly on the charts. Now, in case you're wondering, how on earth this gold and silver compression spring is going unnoticed, Bloomberg's executive editor, Mark Cudmore, I don't mean to pick on him, but he's an influencer. He provides a perfect example. We've seen it almost every morning bar for this morning on Bloomberg coming out and saying, "Oh, gold, no, gold's not a hedge anymore." And so it's just, I use his name because he is a perfect example of how mainstream media analysts how little they understand about gold and silver, a subject they only recently came onto their daily analysis menu because they never mentioned gold and silver for years and years and years. It's just only just come onto their menu, and it's patently obvious they're trying to form fit in any way they can the gold and silver action into a generalist versus a specialist market view. So it's really incorrect information, and completely unaware that China is now the physical dog that is wagging the COMEX tail, and they only look at the tail. And when he, as an influencer, for example, makes sweeping statements that gold must sell off, not just isn't a good hedge, it must sell off because the dollar's rallying. It's unbelievable to me, but it confuses and wrongfoots a lot of traders. And a lot of funds look for direction in the morning at before the market opens, about 10 to 8 in the morning. He tends to come on and say, well, hey, this is what we see. He influences them.
During the interview, Andrew Maguire explains that during recent stock market sell-offs, some investors have been forced to sell gold positions to cover margin calls. Many funds had been using gold as a hedge against market risk. So when equities decline sharply, those gold hedges are sometimes liquidated to meet urgent liquidity needs. However, he stresses that this selling simply reflects the role gold plays as a financial safety buffer during market stress. Maguire also notes that strong sovereign and institutional buying is increasingly offsetting this temporary selling pressure. Central banks and long-term investors are taking advantage of these dips to accumulate physical gold and silver. According to him, this demand is particularly visible in the physical markets linked to the Shanghai Gold Exchange, where supply deficits and strong premiums indicate tight physical availability. Traditional market correlations are beginning to break down as global investors increasingly convert dollars and treasury holdings into physical precious metals. In his view, these conditions mean that price dips are likely to become short-lived, as physical buyers quickly step in to accumulate metal whenever markets temporarily push prices lower. Let's jump into the interview.
Now, liquidity providers report sovereign buying has concurrently stepped up into stock market sell-offs, because that's offsetting gold hedges being cashed in to meet market margin calls. So in other words, not a lot, but some of the risk markets have been using gold as a hedge. And it's been called in when we see a collapse, they're being called in. So it's the selling of that gold is really doing what gold was supposed to do, why they bought it in the first place. But it has to be sold to cover the margin calls triggered by these extremely uncertain war conditions. In fact, given the structural Asian-facing physical gold and silver supply deficits into very, very large SGE gold and silver spot premiums, it's no surprise that fresh safe haven demand is increasingly overcoming a dwindling number of automated Western sellers. Step back from a 10-minute chart and these unavailable physical market stair steps become obvious. Now, liquidity providers report all historical synthetic correlations are now breaking down as central banks, sovereigns, and these institutional safe haven physical buyers step up converting the recently rising dollar into gold and silver. Now, while the current extreme war escalations raised unfactored World War III risks, and it still does pose that risk, and we all think it'll probably peter out at some point. You know, obviously the US is the most powerful military in the world, but I think they've underestimated this whole situation. These are some bad people that they're fighting, and they've had years to prepare. So, look, if this spreads further, and we talk about mining of the Hormuz states and straits and one thing and another, we're seeing a lot of stuff going on that wasn't factored in. This was supposed to be a quick process. So the point I'm trying to make is, regardless of the outcome, is beginning to disrupt global supply chains, fueling equally unfactored stagflationary inflation risks, compounded with unfactored, freshly ignited private credit defaults. Liquidity providers and central banks and sovereign institutional gold and silver demand is just going to simply increasingly offset these bearish automated gold and silver correlations, which are breaking down, meaning with dips will just once again be jumped on. You know, these synthetically derived dips will be jumped on by physical market actors and be very short-lived. In other words, stacking opportunities. That's what we're witnessing here. And under the smoke and mirrors COMEX generated action, funds and institutional investors are looking to significantly increase gold and silver allocations from a very small zero, and many of them had zero exposure to gold, hence why the mainstream media has not been talking about it. And, and at best case, the most that we've seen is maybe 2%, between 1 and 2% assets under management. And a lot of that is in ETFs. And so really they're saying, in fact, almost every bank I speak to now is talking about you need to up your exposure to gold between 5 at a minimum, and in many cases around 20% exposure to gold. Now, to address the massive loss of trust in high counterparty risk unallocated LBMA and CME products, migrating Western funds have been embraced by the highly regulated free trade zone SGE gold and silver ecosystem. And having lost this business, Western bullion banks are racing to participate. And while we've been following the exodus of Western open interest, the chips that used to play in the casino that relate to the unallocated fiat gold that races around the over-the-counter markets, this exodus of open interest, meaning these actors, they're going to the east. They're fed up with the volatility. They're fed up with the games. They're so obvious. When you see a sell-off coming in at literally seeing several years' mine supply sometimes coming in and just being dumped in a matter of a few minutes at a very odd time of day, they're fed up, absolutely fed up.
The decline in precious metal prices comes after a brief pause in trading earlier in the week, with both gold and silver registering downward adjustments in line with movements in the international bullion market, as more investors recognize the limitations of fiat currencies and paper markets. Physical precious metals may increasingly become a preferred store of value. If institutional investors and central banks continue shifting capital into physical precious metals while supply deficits grow, could gold and silver be entering the early stages of their next major bull market? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.